The principal document is the loan agreement, which is a contract between the lender and the borrower. It will govern the legal relationship between the lender and the borrower. So what would we expect to see in the loan agreement? Well, obviously the amount, which is normally a fixed amount, but at the time we draft the loan agreement, it may be that the final valuation hasn't been obtained. So there may be the loan amount may be referenced to the lower of the fixed amount or a percentage of the valuation. The term of the loan, which is typically in this sector is around 12 months, can be longer, but for some people there may be withholding tax issues if it's longer than a year. Obviously the interest rate. Interest rate, how it's calculated, in the sense that is it compounded, and if so, when? How is it payable? Normally monthly in these type of loans, and whether it's a fixed amount. We find it's usually a fixed amount in this sector, but occasionally it is linked to something like LIBOR. Date of repayment. Again, as I've said, the term of the loan is probably around 12 months, and the date of repayment is the date on which the lender expects its principal, interest and all other costs and fees to be paid by the borrower. The loan agreement will also detail what security is being given. And when we talk about security, we're talking about perhaps always a legal charge. If it's a corporate, maybe a debenture. And there may be ancillary documents such as a charge over shares, a subordination deed where we're subordinating equity debt. Obviously the agreement will detail the interest rate, what the amount is, how it's calculated, whether it's compounded, and if so, when. In this sector you often find that interest is rolled up, and by that we mean that the interest is actually not payable by the borrower on a regular basis, but is rolled up in the loan, compounded usually, and is payable in one hit on the final redemption date with principal and other fees. In terms of the rates, it's usually a fixed rate, but occasionally it's linked to LIBOR. In terms of security, the loan agreement will identify what security the lender is taking. That will almost always be a legal charge. It might be a debenture if there's a corporate vehicle. And there may be ancillary documents such as share charges, guarantees, subordination deeds. Subordination deeds are used where we are subordinating equity or third-party debts to the effect that they cannot be repaid before the lender is repaid. The UK has a long-standing and sophisticated legal system, so it's quite easy for a lender to know that it's got security over a defined piece of property. The land registry virtually is a government guarantee of the boundaries of any given property, and the charge would describe exactly what is contained within it. A debenture is a more wide-ranging charge which is used for companies, never for individuals, and it grants a charge over the whole of the undertaking and assets of the company. However, apart from those charges in there which are expressed to be fixed, or for instance the legal charge over the property, the charges are often termed as floating, and this enables a company to carry on its business in the normal way without having to go to the lender for any consent for each little transaction it carries out. So in effect, a debenture creates a charge which, if you like, hovers above the assets and is only crystallised on the carrying out of an event of default. So if you like, the debenture contains floating charge which could be said to be hovering above the assets and undertaking of the company, and only crystallises on the occurrence of an event of default. The agreement will also contain a section regarding fees. It's usual for the lender to have an arrangement fee. Out of that it may be paying an introducer, or it may be an introducer's fee is paid separately. It's also common these days to have an exit fee which is payable on the final redemption date, and if the loan is a development loan, then it may be that that fee is linked to the gross development value of the completed property. The agreement will also detail what rights the borrower has to repay the loan early. That may be in whole or in part. The lender will expect the borrower to give notice, could be as much as 20 business days, but more commonly 10 business days. The lender is also looking for a minimum return on its capital, and therefore it's likely that the borrower will have to pay in addition, say for instance 3 months interest as a minimum, even if it repays before that date. So expect to see that the borrower must maintain the loan at a certain percentage of the value of the property. If the borrower breaches that covenant, the lender can call in the loan, although it may allow the borrower to remedy this by paying down the loan or introducing additional security for the benefit of the lender. Events of default are an important part of a loan agreement. This is where the lender is entitled to call in the loan and enforce its security. You won't be surprised to know that if a borrower fails to make a payment, then that will be an event of default. But it'll also be an event of default if it breaches another term of the loan, such as the loan to value covenant we've just talked about. It could even be on a repair in an extreme case, or failure to comply with insurance covenants. Typically also any insolvency, the appointment of a receiver, the appointment of an administrator will also be an event of default. Cross default may also be important, that is when another lender to that borrower calls in its own loan, and that would trigger an event of default under our loan agreements. Once an event of default has arisen, the lender can call in the loan and enforce its security, although it may not wish to do so immediately. There may be a period of negotiation before that final step is taken.